Hello. We wish to welcome you to our 2022 Outlook and our economic review. As you know, we enjoy talking to you and sharing with you things that are helpful to know about markets and also how we can manage them. So this report is a short one, won't last too long at all. I think you'll find it highly valuable. So our agenda is to look at the equity market and then look forward to what 2022 is according to what we see right now. Before we get started on that, as always, the 5 key areas of financial planning are highlighted: preserving, retiring, tax planning, estate planning, investment planning. All 5 of those are keys. As a comprehensive financial services firm, we always consider all 5 of these areas and how it will impact you. Today's presentation, though, will be focusing upon investment planning. That's what we're looking at. So that's where we are. This kind of gives you an idea. You can see the market from the fourth quarter of 21. The S&P was up 11%. The Dow was up 7.8. Actually, these were fantastic closes. They were records. And if you look at the year, the Dow Jones was up 19 and the S&P was up 27. So it's just shy of all-time highs. You can see there it went down the last few days of December. Fantastic. So we're really happy about all that. This shows that we had 70 record closes for the 500, 45 for the Dow. And this really helps us to appreciate that equities can change directions and they can also roll very strongly for a long time. So we've had many detrimental events, but yet the market showed resilience. They prevailed and they rewarded us, you as our clients, with good returns. So this looks at the Dow Jones historic since 1980. And back in 1980, the Dow was at this very low level, just 1,800, 2,000. And then now we're 35,000. So when you see this, the markets march up. All these different events affect it. In 1999, you can see there was a little effect there with the boom, I should say the bust from the electronic businesses. We see the Iraqi war, the global financial crisis. But notice the coronavirus was pretty deep, but it rebounded very quickly. So we see that it's important to have a solid investment strategy and a long-term focus, because long-term we usually win. Staying disciplined, not being emotional, following your strategy is crucial, very important. So here we're looking at the year across the months. And we see the negatives in January, September, and November. They hurt us, but we had strong returns. Monthly returns are not consistent, but yearly work well. Markets don't move in a straight line. So this is a reminder that we have to be prepared emotionally to handle this economic environment that we have. If you had gotten upset in September with that little bit of loss, you would have lost October's gains. So volatility is part of the investment experience, and we have to understand that. The next thing is, when we look at treasury yields, this is what people get when they invest at the bank. In January of 2021, the 30-year was at 1.66. In December, it was at 1.90. Not much of a difference. The 5-year was even minuscule, but that's what they give you with CDs. They drop down, and we see this as a very interesting event. It wasn't good for bondholders. Interest rates are historically low, so it didn't help people that were keeping their money safe at the bank. We'll give you a little clue here what it cost. The Fed fund rate last week was 0.08, and that was in January 10th. A year ago, it was 0.09, so it hasn't moved enough to get excited about. A 12-month CD currently is paying less than half a point. It's at 0.14, so it's nothing. So they continue to be ultra low. It doesn't work well for income-seeking investors, and CDs are still extremely unattractive. But the Federal Reserve did announce it will begin increasing the Fed fund rates in 2022. We don't know exactly, but we think it will be 3 rate increases. There's a lot of discussion around this right now because, as you know, when they announced the rate hikes, it affected the market and the market went down. They say the Fed rate will probably be about 2.1 at the end of 2023. So that's not a lot. If you look back, you probably were paying, when you first bought your house, the first mortgage, you were very excited to get 7 or 8 or 9%. We're in a different environment now. Markets were goosed, or they were upset with the Fed saying we're raising. It's a temper tantrum because they've had low money for so long. So this tapering timeline that they're looking to do, this is where they no longer buy bonds to stimulate them, but they're going to rather instead focus on not buying them and begin tapering them, perhaps selling them. They want to phase out the bond buying stimulus program, and that will allow them to reduce their amount of debt that they have from buying these. Remember, they have to do something because inflation is way up. Note this chart here. In December, it was 7%, the highest rate we've had in 40 years. This is not good. It's not a joke. It hurts people. It's affected your prices for energy. It has reduced your buying power at the grocery store. Housing has gone up. Automobiles have gone up. Clothing has gone up. This affects people in real time. Why is this happening? There's 2 reasons. It's because of the extra money that the government has put into the market for COVID stimulus. It's also because of the supply chains being fragmented, broken, or at best strained. So those are the 2 things, and people will pay what it takes to get what they need. And that's what's happening. So what are our outlooks? We've still got COVID. AB 1 and 2 was announced last week. We have rising interest rates. We have continuing inflation and they're tapering. Economic growth may be stunted. And we've got tax laws and public policy that is difficult to deal with. However, we still must remember interest rates are still low. So we should be optimistic and be looking for favorable returns. These things will continue. COVID is still a central concern because it's so devastating. Omicron is not as much of a threat as its predecessors, but it's been highly contagious and it's caused a great deal of havoc. We're still not out of the woods, so to speak, with COVID. But this is what we're saying. We should proceed with caution. Even though we've had impressive returns, we cannot be complacent. We must remember where we are and proceed carefully. So knowledge is power. It's very important for us. Educated client is our best client. So we'd like you to review all your income producing investments. Here's another one. Lock in your mortgage rate or consider refinancing if you still owe money on your home. Maintain liquidity for all near-term needs. 90 to 120 days is recommended. Reevaluate. Look at your budget, confirm what you need every month, and maintain that liquidity to cover that. Conduct a full review of your financial plan with us. So that's what we're looking for. We want you to revisit this. Make sure your time horizon is in harmony with your goals. We want everything to keep working just as you planned. Volatility has returned, and it's part of the investment experience. Market pullbacks, downturns are common. We have a long-term strategy, so we're going to stay away from the emotion that can happen during a pullback. Stay on track with your financial goals. Remind yourself to focus on this saying. Focus on your time in the market, not timing the market. If you protect your gains by selling, that's okay, but remember you must come out of the sidelines when the upswing begins. It will affect your portfolio if we don't. So look at that. Here's another reminder. Downturns are normal. Typically, we have a 10% downturn once a year, every 15 months. We have to stick to our long-term plan. Don't get emotional and don't try to time the market. Look at your plan to make sure it fits your needs. Equity markets ended on a high note despite all the negative variables in 2021. Inflation is still expected to be prominent this year. It's not going to go down because of a rate hike with the Fed. It will slow until supply chains come back, until people go back to work, and until we get rid of the excess money from government giveaways out of the system. So tapering efforts will begin to help. Raising interest rates will begin to help, but it's not going to all of a sudden tamp it out. It's going to take a little time. The other thing is, volatility is here. We already know that. It says it could be on the horizon. That's an understatement. So we have to be vigilant and cautious. Focus on your personal goals and objectives. Call us with any concern. We're happy to talk to you, review your account, and discuss strategies that fit your needs. So what can you expect from us? A regular review of changes. We're going to communicate with you, sending newsletters, sending out videos. We're going to send out emails. Review, review, review. We're going to look at the economic, the tax, the estate, the investment issues that all of us face. We recommend you contact us. We want you to look at what we're doing for you, particularly the tax ramifications. Look at your risk. Look at the time horizon. You can expect us to do our part, and we want you to take advantage of that. If you know of any other clients that could benefit from our firm, add their name to our viewing list. As you know, we were going to have special events for those that added names for us last year. It didn't work because of COVID, and we were going to do it again this year. It didn't work because of COVID. But yet we're rewarding you with an opportunity with some gift cards to those restaurants. So here is our little stuff that we have to read. It's the little disclosures. But here's the big one. Thank you. We appreciate the opportunity we have to assist you with your financial needs. Please remember your health, your well-being is our highest priority. So please don't allow that to become part of the situation where we're compromising our health. Stay healthy. So until our next event or our next update, please enjoy and feel free to contact us at any time. Good night.